The Dow Jones Industrial Average dropped 1,100 points for its biggest decline since 2020, and this marks the fifth day out of 2020 so far that we have seen over an 800-point decline in the Dow Jones Industrial Average. Now, exactly what is going on? Because you have consumer staples, consumer discretionaries, you have basically every sector of the stock market that sold off in a very dramatic way. The Dow was down about 3.5%. S&P down over 4% on the day. The Nasdaq down 4.73%, and the Russell 2000 down about 3.5% as well. There was nowhere to hide in today's sell-off. So I want to go over really what is happening today, why this is happening, how long this could last, if we're going to hit new lows, in my personal opinion, obviously, and get into all of the information that you guys need to know. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Most importantly, if you guys want to get yourself those free stocks with Webull, Moomoo, and Public, down below in the description. Check that out. Not a bad time to get yourself those free stocks considering everything seems to be on sale right now. So what is actually happening today and what is causing this? It's going to be earnings, and it's earnings from companies you would not expect to drop the markets, 4.5% or 4% on the S&P, almost 5% on the Nasdaq. These kind of earnings you wouldn't think would do this, but really one of the biggest upsets to earnings today was Target. They dropped over 25% after the company says high cost inventory woes hit profits. The key points: Target shares dropped sharply on Wednesday after the company said its quarterly profits got hit by supply chain troubles, higher fuel costs, and lower than expected sales of discretionary merchandise. Discretionary is like you can choose, right? Like an iPhone would be discretionary compared to a $200 phone, right? You would say a phone is pretty essential. That's a staple. You need some level of communication in your life for the most part, but some things are discretionary versus not. And you're seeing major retailers saying, hey, not only are we seeing gas prices going up, we're seeing inflation hurting our bottom lines a lot, our profit margins, but you're also seeing these same businesses saying, hey, people are just spending less money, that they're not buying as many discretionary products, and that is not good. And you're really starting to see more of this recession kind of fear starting to kick in. Now, this is also digestion, in my personal opinion, from what the Fed just said about 2 days ago. Essentially, or was that yesterday, 2 days? What? It all blends together. Essentially, what the Fed said was, we're probably going to see a recession. There's not too much we can do about it. We can't control supply chain inflation, supply chain issues, but we can bring down the demand, and basically pointed to the labor market saying, hey, for every one person that wants a job, there is 2 job openings. That's not good. So what Powell basically said is they have room to just raise rates as much as they want, even going past that neutral rate, which a lot of economists believe is in between 2.5% to 3%. So there's a lot of fears about the Fed raising rates so aggressive they put us into a recession. And then you're also seeing these major staple retailers, staple meaning a Target, a Walmart, a Home Depot, businesses you have to shop at, right? You have to get food, you have to get these products from these businesses that are not painting a pretty picture for the actual consumers or customers, which would be us, the American people, for the most part. So that's not good, and that really hit the markets in a very substantial way. Apple specifically did help to drive everything down today and really led the way for the most part. Apple dropped about 5.64% here in regular trading, down 0.17% here in after hours, and it wouldn't surprise me to continue to see more downside pressure over the next couple of days. Look at Cisco. They just reported earnings here in after hours, and they guided for a negative year-over-year growth rate, and they're down almost 16% here in after hours, and it's not looking so pretty. So you're just getting back-to-back bad earnings with lower guidance as well as lower profits, and that is not a good thing for the markets. On top of all of that, there's a lot of concerns about the price of oil, as it has been spiking and pretty much going crazy. Even in Michigan, it's almost to $5 a gallon for gasoline, for regular gas. It's getting out of control. And essentially, a lot of people are concerned because the higher oil goes, the greater likelihood you have of seeing a recession. I know if you were somebody that drives a lot, you're cutting back one way or the other because it is just so expensive to do things, to go anywhere. And the biggest traveling time of this summer season that we are heading into is from Memorial Day, which is right around the corner, all the way until the 4th of July. Then you start to usually see a downtick in the price of gas after the 4th of July, but obviously there's no guarantees this time around, and given the state of the energy markets and the way that it's just not getting better, there's nothing that is really changing here. If anything, things are getting worse, then you have a greater likelihood of going into recession because people are obviously needing to cut back on how much they travel. If you travel a lot, it's very expensive. It's 2 or 3 times more expensive this time this year than it was last year to do the same amount of driving or traveling. So people are definitely cutting back. Not good for the overall economy. And what you're seeing reflected with Target, Walmart, Lowe's, Home Depot, it's not painting a pretty picture, like I said, for the overall consumer. Now, on top of that, we are coming off of retail sales, which I thought would have been much better for the markets, because we had retail sales that were expected to come in at 1% yesterday. They came in at 0.9%, which was pretty much on expectation. So it was overall a small miss, but still really good. Like, it could have came in negative. It could have came in substantially lower. And that's why you did see a bullish reaction to that data. Yesterday, you also did have China saying that they're going to ease restrictions in Shanghai. And that was seen as a very bullish thing for the markets as well. But these new earnings are just destroying the markets. And it looks like a lot of major stocks, even the S&P, are taking bigger moves down here in after hours, down about 0.33% on the S&P 500, just here in after hours alone. Pretty substantial moves. We dropped $16.50 in the SPY today alone. The volatility is here, and we are going back down to the lower end ranges. Now, I will say there is not too much news for the rest of this week. We've talked about this a couple times. We might have some Fed speakers here and there throughout the week, but the only other real data points we have is real estate data. Other than that, there's really nothing that should move the markets unless we do get headlines from the Europe conflict or from COVID and China. Those things can come out of thin air essentially at any time and either help the markets a lot or hurt the markets a lot, but we don't really have any data for the United States specifically that should move the markets one way or the other. Now, at the same time, this might be a little bit of cause for concern as far as the markets are concerned, but you actually do have Turkey that rejected the SWIFT NATO approval for Finland and Sweden. So that could have some implications, if Russia were to really attack one of those other countries. I mean, you're talking like full on World War III if it has not already started, and that's obviously not going to be a good thing for the markets. Let's just call it that. After all, this is the worst start to the year in the stock market that we have seen since 1939. And what started in 1939? Well, World War II. So a couple things to keep in mind here. It doesn't look like there's an easy fix to any of this, but that does not mean you could not see the markets go up, right? The markets are going to be very volatile. That's why it's very hard right now to actually trade the markets, because they could be up, 2 to 3.5% like they were yesterday, and now today they're down even more. We've given back all of the gains from yesterday plus some. So that's why it's so hard to trade this market. I truly think this is the greatest wealth creation period that we could hope for a very long time. I think once the markets come out of this downturn and things go back to normal, whatever normal is at the time, I think the markets are going to be in a much stronger and much healthier place, and this could be the buying opportunity of a lifetime. And it could be longer lasting. It could be a year or two, and this will give you time to load up on your favorite stocks and build out big positions to inevitably ride the wave once we do ultimately go back up. Now, before we dive into SoFi stock, you got to give this damn stock a round of applause, because SoFi was up 2.55% on the worst day in the stock market that you have seen in 2 years, specifically for the Dow. Not quite the worst day for the Nasdaq, but I do believe this is the worst close for the S&P 500. I might be wrong in that, but it's close. It's close to the worst close that we have seen in 2 years for the S&P as well. Now, through all of this, why is SoFi stock green now for the 6th straight day in a row? It's like SoFi doesn't even care what happens to the markets. This thing is doing its own thing and actually just broke out of its previous levels of resistance, which was at about $7.16 per share. We did close above that. Considering even this 0.5% move down in after hours, you're still above 716. So the technicals are looking pretty good. But why is there bullish price action for SoFi stock to begin with? Well, you're seeing a lot of very bullish 13F filings coming out. A lot of institutional investors are buying, some of these are millions of shares of SoFi. You are seeing a lot of puts as well that are coming with a lot of those long-term positions, but they're by and large a lot of short-term hedging. After all, like, puts in its purest form are forms of insurance. That's why they are called premiums, right? What you buy an option for is called a premium. It is essentially insurance. So if you're taking on a new position like DE Shaw & Co. is right here at about 2.5 million shares, yeah, they went ahead and bought $1.4 million worth of a call position, but they also did buy a put position worth about $2.3 million. That's just a short-term hedge because there's so many risks to financial stocks as of right now. Consumers slowing down, inflation, right? The odds of a recession are getting more and more known and prevalent. Seems like every single day. So there's a good reason to short-term hedge out a very large position, but by and large, these firms are likely buying and holding for the long term because they find some real value in SoFi. So that's very good. Earnings were very good, and on top of that, insiders are continuing to buy the dip on SoFi stock. Anthony Noto, like we talked about, he did buy about $250,000 worth of stock, and you did see this director that just bought about $97.5 thousand worth of SoFi stock as well. And I've said this a couple times, but it's not going to hurt to hear it again. There can be hundreds of reasons why insiders would sell stock: to pay taxes, buy a boat, buy a house, get a divorce, just do anything, right? Vacations, kids' colleges, whatever the case is. Hundreds of reasons you would sell stock. There's only one reason you would buy stock, is because you think it's undervalued, the company is doing well, and you think the price of the stock will go up over time. That's it. That's the only reason why you buy stock. It's not to pump up your stock in this kind of market environment. That such thing does not work. That might have worked in 2021, in 2020, but not in 2022. And these guys know that. So these are long-term positions. On top of, these guys already own a lot of shares anyways. Anthony Noto owns 3.2 million shares. That's worth like $50 million, or give or take whatever the number is. It's worth a lot of money. So the fact that they continue to buy more is, showing that, hey, there's probably a future with SoFi. So those are really the reasons I think SoFi has been very bullish. The 6th straight positive day in a row is pretty damn impressive in this market environment. Now, you are seeing, like I said, a lot of put activity on the option chain, which is even more impressive considering the stock has had so many green days in a row. Look at the order values for the day. The positive order value of 32%. You are seeing 6 orders totaling $1.02 million. So a lot of these puts that are coming through for stupid high amounts as well, like 8 million, 6 million, 4.5 million, 1.67 million, 1.35 million, 3 million, 1.23 million. These are all single orders for puts. So what's happening right now is institutional investors, like I said, they're buying a very large long-term position, but they're also buying a very large short-term put position. A lot of these short-term puts are for June 17th. A lot of them are actually concentrated around June 17th. You do got some a smaller January 2023 put position, but most of them are around June 17th. So that is not going to allow the stock to really go on a parabolic rally, because when you're buying these put positions and you're spending $7 million in an order, you're buying them close to the money. So if the stock goes down, say 0.5%, market makers have to go out and short a bunch of stock. So considering what you're seeing, I would say it's bullish, but here in the very near short term, I call it the next 6 to 12 months, it's going to be a big dragging weighing factor on SoFi stock, all of this put activity, but still impressive nonetheless. The stock is up 2% given all of those puts that are on the option chain. Kind of crazy when you look at it in that perspective. Now, the short interest of free float is sitting at 20.69%. Current shares that are sold short, 150.59 million. Cost to borrow max is sitting at almost 15%, and the utilization is still at 100%. Days to cover is sitting at 4.19. So I will say this is not a short squeeze kind of trade. There's a lot of shares outstanding. We do have a reverse split vote coming up. There's not a huge reason, to get a lot of FOMO into SoFi and to actually see a short squeeze. But once market conditions actually change and there's a fundamental positive change that is long lasting for the markets, meaning inflation comes down month over month in a dramatic way, or the Fed does U-turn, then I think that's going to be really when you could see a lot of these shorts actually cover, and you could see SoFi go up. It could look like a short squeeze, but we will go up and we will actually stay up, and we'll start to actually trade off of the pure fundamentals for SoFi stock and what the long-term growth outlook does look like, which is still very much intact. We just had earnings, like I said, that were very, very good, and it's very hard to make a bearish case considering the earnings that SoFi is putting up, even when its largest segment of its business has been shut down for really the past 2 years. So that's that. As far as the key technical levels, like I said, we closed above 716. That's going to be the level that I really want to watch. If we can hold above 716 tomorrow, if we do get a bounce or whatever the case is, or maybe it's the 6th or 7th straight day tomorrow that SoFi stock is green, then I think we'll come up and start to test out the 50-day moving average, which, as you guys know, has been a long level of resistance for a long time now. Ever since about November, we have not been able to break above 50-day moving average. If we can, that's going to be a very bullish thing here in the short term. But honestly, I hope SoFi stock goes down so I can acquire as many shares as possible before, market conditions actually turn around. This is, after all, probably one of the last great buying opportunities that you are going to see for possibly the next 5 to 10 years once the markets actually do go back to normal. So I want to take full advantage of that. The RSI is sitting at 53.20, so there is a lot of room to continue to rally before you are overbought on the RSI. A lot of people like to talk about that, but you're not even close to overbought on the RSI right now. You would think so, but there's been a lot of carnage to this stock in a very short amount of time as well. Just in the past 2 weeks, we've fallen down from 7 down to 5. Now we're back up to the same level we were at just back here, call it May 4th and May 5th. So in the grand scope of things, in the last 10 trading days or so, you've moved around a lot, but you're still at the same level you were about 12 trading days ago. So just think about that. The MACD is extremely bullish right now, not necessarily an indicator to the fact that we have to drop. Actually, quite the opposite. The MACD has a lot more room to actually go bullish here if the bullish sentiment and momentum does continue. So we'll see what we have in store. Not a lot of economic data, not a lot that could potentially move the markets. Really, I would pay attention to the crypto markets, what happens over there. That's going to be very important. Pay attention to China. Pay attention to the Russia situation. If they attack Finland or Sweden or something along those lines, that's not going to be a good thing. I think that goes without saying. The markets would probably see a similar reaction on that day as what we are seeing today as well. So that is basically going to be it. On the S&P 500, we did close at about 391.86. Watch to see if we can hold up support at 390. If we cannot, watch to see if we hold up support at 385. If we don't, then you're probably going to 380. If you don't find support there, you're going down to 360. That's really the game plan that I'm looking at here. That's going to be much closer to a bottom, but I don't expect all-time highs anytime soon until, like I said, inflation does come down for multiple months in a row and the Fed stops raising rates as aggressively. That's when the markets will bounce back, but this is not going to be a V-shaped recovery because the Fed is not your friend. So that is going to be all for this video. Hit that like button, subscribe to the channel, source comments, questions, or concerns down below in the comment section, and get your free stock down below in the description of this video as well with Webull, Moomoo, and Public. Thank you guys for tuning in. You guys enjoy the rest of your night, and I will see you in the next one.